Well, good morning, good afternoon, wherever you may be joining us, either live or watching this on replay. It's John Terry with Vision Advisors, and I want to say thank you for taking some time out of your busy schedule to join us today for what I believe is going to be an interesting conversation about how you can add $1.2 million a year in new production in your business every single year by learning a little-known strategy that is often overlooked. And as a result of that, it's going to give you some opportunities that maybe you haven't considered before. Now, for those of you that don't know who we are and it's your first opportunity to join us, let me take just a quick moment and introduce us. We are Vision Advisors. We are a marketing-focused IMO who really does one thing well. We help the individuals that we work with, independent financial advisors, just like you across the United States, get in front of more qualified prospects. If you can think of the type of customer that you would prefer to get in front of over any other type of customer, we work with you to help you create unique marketing strategies and solutions that allow you to do that. Now, just like any other great IMO, we've got some great product, but we are known for what we do in the area of marketing. And what we're doing today is just one additional way that we help add value to you as our producers is introducing you to vendors and resources that we have that can help you expand what you're doing, get in front of a qualified prospect, and have an opportunity to solve their money problems. Now, on the call with me today is George Gonzalez. He runs Green Education and a second company, 123 Fast Forward, but we're going to focus on Green Education today. And we want to take a few minutes to talk about something interesting that's going on in the news today, and that's Social Security. I don't know if many of you saw the report that we posted to our Facebook and our YouTube channel just a couple of days ago. There was a report out of Boston College that COVID has significantly impacted the drop dead date in terms of when Social Security begins to become insolvent, i.e. when there's an insufficient amount of dollars coming in from tax revenue to fund the outflows going out to those individuals that are going to be utilizing Social Security during their retirement years. In fact, they've now moved up the date of insolvency to 2034 as the date when Social Security is only going to be able to provide about 78% of the promised benefits to shareholders in the event that they don't make some significant changes in the Social Security system. Now, with all the challenges we've got going on right now in a polarized Congress and Senate and President, nobody wanting to work together, that's going to be a challenge that we as a nation are going to have to face. But in the interim, as we're doing planning, there's some overlooked areas when it comes to Social Security planning that oftentimes make the difference between having the type of retirement that your clients dream of and them ending up having to pay more money in retirement than they anticipated. And who better to talk about that today but George Gonzalez. So, George, let me first off say welcome to Vision Advisors. And if you would, just kind of greet everybody that's joining us live and those that'll be tuning in later for the replay. And just give us a little bit of your background, if you don't mind, for us to get started today.
Certainly. Thank you again, John, for the opportunity to address your group. It's a pleasure to be here. I am a full-fledged financial advisor, have been in the financial services industry for 32 years. I have the opportunity to work with Fortune 100 and Fortune 500 companies throughout my career, holding different positions as regional sales vice president of 27 of those 32 years. About 5 years ago, I had a situation that prevented me from continue working with corporate America. I became independent, and it's been an incredible ride ever since. So I'm, again, thrilled to be able to address the group, and I'm ready to, show you a way that definitely we can add substantial revenue to your production every single year.
Absolutely. Well, George, I know one of the things that when you and I were talking earlier, we were talking about the important role Social Security plays as we think into helping our clients plan for a secure retirement. And if we look at the statistics that are out there, most retirees today are going to rely on Social Security to replace anywhere from 40 to 60% of their pre-retirement income. George, as you've been working in the corporate space and then also as an independent producer, what role are you seeing Social Security play with the clients that you and the producers you work with are involved with as they're helping individuals plan for retirement?
It is definitely a hot topic of conversation. The research that we have done, it's really creating a big challenge for some of the planners and agents that are not really including this topic of conversation. But it also will allow us to work with other professionals like CPAs and attorneys, because you have a lot of companies, you have a lot of professionals out there recommending for people to delay, for example, taking the Social Security check. Whether that could be a good idea for some, it is not a good idea for the majority. And we're going to cover, part of the presentation today is basically to cover what can happen to people and basically to the professional if you are making the wrong recommendation. There is also a lot of noise around the fact that Social Security is working on a huge deficit and that is going to be disappearing, soon. What many people do not take in consideration that is that when you turn 65 and you don't have any other means to pay for health insurance, it is mandatory to enroll in Medicare in order for you to receive the Social Security benefit. So part of the conversation that we're going to have today is how is the correlation between Medicare and Social Security can affect or can benefit the opportunity to working and servicing our clients on the distribution phase at retirement.
George, you bring up an interesting point of conversation, and that's a couple of things that you really touched on there. First off is the claiming scenario in terms of, do I claim early at age 62? Do I wait and claim at full retirement age? Do I defer that until age 70 so I can take advantage of those delayed credits? That's an important conversation that needs to be part of the dialogue that any financial professional has with their clients as they're moving into this phase of life that we call retirement. And that for a lot of folks is going to end up being 20, 30, 35 years. That's a significant amount of time they're going to need guaranteed income. So making that Social Security decision is going to be important. But you also touched on the fact that Medicare and Social Security are intertwined. And when someone turns 65, they have to apply for Part A Medicare. They can defer Part B if they're still working and they have health insurance coverage where they're at. But there's a unique connection there that many people don't think about when they're looking at doing their planning, because that Part A Medicare has to be paid somehow. So can you touch on that unique connection between Medicare and Social Security and why that's an important part of planning that may often be overlooked?
Definitely. It's a quick story. I always said, everyone knows Uncle Sam, but almost no one knows about Aunt Irma. So the story goes like this. Medicare, Medicaid were established on July 30, 1965. We already mentioned that before you are eligible to collect Social Security benefits, you are required to enroll in Medicare. What many people don't know is the fact that you will pay for the cost of Medicare out of your Social Security check. So what you will be getting, it is basically the net amount after the cost of Medicare. On Part B and Part D in some states need to be deducted from the Social Security check. So your income plus where that income is coming from will be determining how much money you will have to pay for the premiums of Medicare, and also how much of your Social Security check is going to be subject to taxes. The only way that Social Security income is not taxable, it will be if Social Security income is the only source of income for you. And then you have another situation because you could be subject to surcharges and in some cases for penalties if you didn't enroll on Medicare when you were supposed to enroll, or if you're receiving too much income from different sources.
So that can potentially be a compounded problem. If someone fails to file for their Medicare benefits at the appropriate time, there can be penalties involved. And based upon the amount of additional income from other sources they have coming in, that is taxable income, that could create an additional surcharge on their Social Security they haven't considered. Is that what you're saying?
That is correct. Yes.
And so as a result of that, that creates a problem in planning that many advisors have overlooked. So, George, how prevalent is this problem that we see across the country today?
Well, the situation got worse because since Medicare was created, like I said before, in 1965, the level of income that people were subject back in 1965 was a lot of money back then, but right now is not really a lot of money. So when one is receiving, right now it's $88,000 of income, then if your income goes above that level, you will be subject to the surcharges of the Irma that I didn't believe that I mentioned what is Irma or what it means to be subject to Irma. Irma stands for Income Related Adjustment Amount. And every time your income goes above $1 on any of the 5 income levels, you will be paying a surcharge on the cost for Medicare. And, the income that is defined to do the calculation will include the traditional, Social Security payment amongst most of the assets that people are going to include when they're planning to get retirement income. So your qualified plans, your real estate, your, rental income, if you sell or you win the lottery, if you get an inheritance, anything that you will have to pay taxes on will be subject to this calculation.
And so as a result of that, as we're thinking into how we help our clients plan for retirement, making sure that they're being able to keep as much of that Social Security check as possible, then what you're saying, as I'm hearing you, is that we need to really consider this Irma calculation to make sure that we don't put our clients in a scenario that they're going to be penalized by taking too much money in retirement.
That is correct. Yes.
So one of the solutions to that would be what? And looking at how we do some of that planning, we're sitting down with our clients, how do we approach this conversation with them? And then what are some things that we could do to create a solution that allows our clients to keep more of what they've put into the system, as well as keep more of the money they've saved for retirement?
Our solution will start by asking 2 simple questions to open and engage in conversation when we are prospecting new relationships. My first question to a client will be, are you aware that you have a mandatory cost in retirement? And my second question will be, do you know that this cost will become the highest expense for you if you don't plan for it? The answers to both questions most probably will have nothing to do with what we have to offer, but they are going to be talking at one point or another with what they consider to be the most trusted advisor, which happens to be their CPA. So probably in the past, you have tried to partner with, an accountant. And if you are like most of us, there are main reasons that probably you have experienced little or no success in the past. So we have put together a program that will allow us not only to be able to address this known public fact, because everything that we're discussing here today, it is public information. All you need to do is just to go to Medicare.gov and look for Irma And then you're going to be able to see the levels of income, the surcharges, so far and so forth. So basically, we work with the CPAs because the CPA represent a great opportunity for us to engage in the conversation with those that are going to be subject to this problem sooner rather than later, which are the high income earners, the business owners, and the people that unfortunately are receiving the letter from Social Security that their income has been substantially reduced because of the Irma effect that we were talking about. So how do we do it? We are partnering with a company that has created a software that is able to recognize, address, and manage the problem in a way that the CPA will actually be able to address it with their client.
Excellent. And so as we're thinking into the solution, and I'm going to ask you in just a minute to take an opportunity to share that software solution with us. But in terms of thinking into the financial professionals we have on the call with us today and having an opportunity to watch this video either live or through the replay, as a result of the planning that you can engage with in using this software tool and raising this specter of Irma that many people maybe on this call hadn't even heard about up to this point, what are some of the remedies that can come from that, and how does that benefit the client, but at the same time position the financial professional that's on this call, the insurance professional? How does that help them create an opportunity for more life insurance, more annuities, or other financial products and services that client may have need of?
That's an excellent question. Well, we go through the discovery process first. We normally are going to determine how big of an impact or how big of a liability will be if they don't do any type of planning. So the discovery phase is very, very important. Many people wait until the very last day before they're going to go and apply to get Social Security benefits. So the sooner the better, like any other type of planning that we do. The second part comes with doing a full analysis, which is basically determining what are their assets, if they are going to be subject to the recognition as a Medicare means testing asset. And more important, the implementation. It takes us to a place where the accountant or their attorney, which is most of the time the most trusted advisor, cannot go, because most of the solutions that we bring to the table, we will utilize insurance-based solutions. So we're going to use, of course, life insurance products. We're going to use annuity products. We're going to use long-term care or asset-based long-term care products, or a combination thereof. So we are also partnering with a law firm, and we work in conjunction with the CPA, the attorney, the third-party administrator, and a full team of professionals in order for us to be able to put it in a place that the government is not going to change their mind later down the road. So we utilize some other strategies that can also make this decision, irrevocable, to be able to enjoy, the benefits of reducing at the same time the tax liability of the clients that we're working with.
Excellent. Well, you have screen sharing capabilities, George. Would you like to go ahead and just pull up the software solution that you've got and maybe just walk us through a sample idea of how we would utilize this tool and some of the coaching that the producers would receive from you and your team as a result of having an opportunity to do that?
Yes. I am going to share my screen. Can you see my screen, correct?
Yes, I can. Thank you.
Great. Yep. So we're going to give you the example of Fred and Wilma. Fred and Wilma are married. They're 53 years of age. They are going to be receiving or applying for Medicare, retiring at age 67. they file their taxes married and they do it jointly. They are in the state of Florida because that's where I'm based for, but I can do it with any state, as you can see here. This is a federal issue, it's not a local issue. I already took the liberty to do the calculation on their Social Security income that they will be receiving. And we utilize a cost of living adjustment, which is very conservative, of 2% on this amount. So if you are not able to know how much is their Social Security benefit, all you got to do is just to click here, and this will connect you directly with the Social Security benefits calculator. So I'm going to add some of their assets that they own. So we're going to start with their 401k. And as you know, 401k, it's a great retirement asset because you're able to take deductions with your contributions. You get your employer matches. Everything is, dandy. The problem is that when you start withdrawing income at retirement, then you get this problem. So they expect to have about $800,000 balance at retirement at age 67. I'm going to use only a rate of return of 4% because that's the same withdrawal rate that I'm going to utilize, which is 4%. So if you do 4% of 800,000, that is going to give you $32,000 of income. If I divide that by 12, so it's 32,000 divided by 12 is going to give us an income stream of 2667. I'm going to add another asset. They own a brokerage account. And this situation, the owner of that brokerage account is the spouse. They're going to have about $500,000. Again, age 67. Growth rate 4%. That's the same withdrawal rate. 4% times $500,000 is going to give us $20,000. The monthly withdrawal amount is going to be about $1,666. They also own rental income. 67. They're going to be getting about $2,800 a month. Last but not least, they have an IRA. And this one is on the wife, Wilma. I'm going to use the same number, $500,000, just to make it easy for the illustration. 67 is the age for retirement, 4%. We already know that this is 1667. All right, so safe to say that they have done pretty well, when it comes to generate retirement income. 3450, 3250, 2667, 1666 two times, and 2800. So we're going to do the calculation of what will be their potential liability for Irma. I'm going to include Medicare Part B, and this is the cost without any surcharge. I'm going to include Medicare Part D, which covers the prescription medication. And I'm going to include a Medigap policy because we all understand that Medicare does not cover 100% of all medical expenses. Normally, they're going to be covering 80%. So we need to buy a supplement to be able to get that. Normally, I get a lot of people that, they get surprised when I do this calculation. So the calculation is going to be done from age 67, and it's going to take us all the way to age 90. Because if they're married and they get to be age 67, I can almost guarantee that one of them is going to make it at least to age 90. So I'm going to update, and I'm going to show you the results. So just by having those assets, the projected Medicare premium cost to age 90, it is $1.842 million, almost $843 million. This black line represents the Social Security income that Fred is going to start receiving at age 67. And like I said before, we are increasing this number by 2% every year. This red line represents the cost of Medicare Part B and Part D premiums, which of course are getting deducted from the Social Security check. The problem happened when these two lines cross paths, because this blue line represents the difference between the Social Security income and the cost of Medicare. So this is Fred and this is Wilma. As you can see, this is an individual calculation, but it's done on both lives because they filed their taxes jointly. So the problem with them is that because they have done so good on generating income for retirement, they're getting penalized from the get-go because they are hitting the first Irma bracket from the first day that they receive the first Social Security check. And again, they're not really delaying the fact that they want to wait longer to receive Social Security benefits, because if we wait longer, the Social Security check is going to be bigger, and then we're going to make the Irma problem bigger as well. So you can see here that they're going to be pretty much on the first Irma bracket until they turn age 80. The problem becomes that at age 80, they're going to jump from paying a total cost of $60,900 and change to pay $82,425.61 just because their income exceeded the bracket was exceeded by $1, and they're subject to the second bracket of the Irma calculation. Let me check. I don't believe that they hit the third Irma bracket, but still, when they're really into their mid-80s, they're paying a ton of money that, you know, it's reducing, it's eroding the Social Security benefit that they will be getting. The problem gets a little bit worse when one of the two spouses passes away. Because like I said before, the calculation is done individually. Each person has an exemption right now of $88,000, per year. I mean, yes, of income per year without paying any surcharges. So when one of them is no longer here and the income level remains the same, that's when normally they're going to get the letter from the Social Security Administration explaining to them that they are now subject to an Irma bracket that they weren't subject before. Do I have any questions before I proceed?
No, I think that's pretty self-explanatory. We've got no questions from the audience at this time.
Great. And this is wonderful because, of course, we wouldn't like to be part of the problem if we weren't part of the solution. So I'm able to edit this scenario. We are able to create the strategies that are going to be able to, for us, to reposition their assets. They will still receive the same level of income, but we will be able to reposition their assets in a way that they're not going to count for the Irma calculation. So, well, let's see what happens if I remove, for example, their 401k. Again, I'm not removing the income. The income is going to be received at the same rate. We're just going to be receiving that income that is not subject to the calculation. I'm going to remove their IRA. And let's see what happens to the previous scenario. So we just were able to save them about $500,000 on the calculation because, again, on the same example, the lines don't cross until further, down the line. And it happens the same for Wilma, same as it happens for Fred. The reason being, we don't really hit any Irma bracket until they're well into their late 90s. So needless to say that when I show this to the client and I say, well, let me fix it even further. Let me remove, for example, the brokerage account. And let's see if that does the trick. Then the lines don't cross anymore. We look like heroes. And our clients were able to save a little bit over $550,000 on the calculation. Why? Because there is no Irma bracket whatsoever. So the moral of the story is, even if one of the two spouses dies with proper planning, we will be able to help them reduce or, in many cases, eliminate the Irma bracket. The good news for them and the good news for us is that we are doing it in a way that is helping us position more of the products that we want to position, and we are able to do it in a way that even if the government changed the rules down the line, they wouldn't be able to change the rules on the strategy that we put in place because it's going to get grandfathered in. So I'm going to stop sharing my screen.
Excellent. So the software gives us the ability to sit down with the clients and work through a series of what ifs to identify what assets need to be repositioned, and then working with your team or with their local CPA and attorney, they can create the appropriate framework to protect these assets, still be able to have access and utilize those as needed, but avoid the Irma surcharge. Is that essentially what you're telling us we can do, George?
That is correct, yes.
So who wouldn't want that? I mean, what financial advisor on the call today would not want a solution like that, to be able to look like the hero to the CPAs that they're working with, to have an opportunity to meet with an attorney that's working with high net worth clients, that's working with business owners, that are working with people that have already been notified by the IRS they're going to be subject to this Irma surcharge, and have an opportunity to step in and be the hero. That is essentially what you're bringing to the table, correct?
That is correct, yes.
Excellent. So, ladies and gentlemen, this is a unique resource that we have available here at Vision Advisors. We have asked George to bring this resource as something that we can offer to the financial professionals that are contracted and doing business with us, and this is a tool that would be available to you. Now, George, to utilize this software, to have access to the training and the other things that you guys offer, which is quite a bit, can you get into what the financial arrangements are to be able to license this software for their agency to use, and what all they're going to get in terms of resources in working with you guys?
Thank you. Well, this is basically not only the software, because the software it's a great tool, but it is a full coaching and mentoring program on how to maximize the opportunity of using the software to be able to get partnerships built, or strategic alliance partnerships with attorneys and CPAs. So the situation is that many of our clients are going to come first to them, and they're going to do pretty much what the attorney or what the CPA is going to tell them to do. So with our coaching program, we are able to work side by side with you, and we are able to train you in a way that you will be able to recruit a number of CPA firms. So the CPA chapter in Florida did a study, and we discovered that the CPA firms that we are able to work with, they are going to have, in essence, around 500 clients. Out of the 500 clients that they have, they are going to have at least 300 or so that they are participating in qualified plan. The average balance of the qualified plan, it is about $106,000 of balance. If you multiply that times 300 on average, you are working with a potential assets under management that are $31,800,000. So when we made the agreement to make this presentation, if you are only to be able to convert this asset at a rate of 5%, at a rate of 3%, you will be able per year, you will be able to generate premiums that are going to be in excess of $2 million each and every year. So our goal is to be able to help you, train you, mentor you, so you don't do the mistakes that most advisors do when they approach the attorneys or the CPAs. That's the first step. Second step, we are going to train you and coach you again on what companies are more prone to do and to put in place some of the strategies that we're going to be using for the implementation process. And most important, how they can maximize the value of doing the investment on a trusted structure, a company, or any other legal structure that we decide to use in order to make it for the government not to change their mind. All of these process and all of these a partnership, it's result driven. There is no fee for basically do or take a look at the program, but once you decide to enroll, the monthly investment, it's only $250 a month, and you will have access to the whole structure, the software. You will have access to our team. You will have access to, of course, the coaching sections that are going to be helping you take your business to the level that you want to take your business at.
So I was just sitting there doing the math. We look at $250 a month. You sell a $60,000 annuity, you've essentially covered the cost of the software for the entire year.
For the entire year, correct. Yes.
And you're talking about getting in front and generating revenues. If we're doing a 3% conversion rate of around $1 million a year, and the cost of the software is $250 a month to generate up to $1 million a year in additional premium, that's a pretty good trade-off, I think, in terms of doing some math. If I get my pencil, and I don't have to get it real sharp to make that number work well.
That is correct, John.
And one of the advantages of doing that through Vision Advisors is, as you do business with Vision Advisors, we have a very lucrative money to market program that, as you're writing qualifying fixed index annuity, cash value life insurance, or asset-based long-term care, we create a pool of money that you can utilize to be reimbursed for marketing related expenses, which would include the use of this software. So having an opportunity to work with us and do business with us, not only do you have access to this very unique tool that very few, if any, other organizations out there outside of a couple of broker dealers have available to them. This is a very unique tool that you're going to have available to you that you can't just get anywhere. And we give you the opportunity through the business you write with us to have part or all of that monthly subscription reimbursed to you based upon your production with Vision Advisors. So that's a pretty good win any way that you look at it. George, I'm looking to see if we've got any additional questions from anybody in the group at this point. So let me ask this as we get ready to wrap up. Are there questions that I should have asked you, or the producers that are on this call should have asked you, that they need to know before they make a decision whether or not this might be a good investment to have an opportunity to grow their business in 2021 going forward?
The only question is, and I get this a lot from producers, they have the wrong belief that, for example, the government is going to be able to fix it down the line because they're not going to allow Medicare or Social Security to go broke. That couldn't be farther from the truth. As a matter of fact, there are two proposals on the table right now. One of them is to lower the eligibility age to enroll in Medicare. They want to make it mandatory at 60 and instead of 65. And the second is the fact that they lower the top 3 levels of income for Irma on January the 1st, 2018. There is also another proposal that they might be reducing also the income brackets, the first income bracket and the second income bracket, to somewhere in the neighborhood of about 60,000. So if that happens, there is going to be a lot more people, that are going to be very, very unhappy. And, the whole information, it has been in front of us, since the beginning of time, because this is, again, a numbers game that we need to either become a part of the solution or continue to be part of the program because we were uninformed.
Yeah, and I've seen that proposal too about talking about lowering the levels at which the Irma surcharge would kick in. And there's a lot of conversation that is a likely process that we're going to see play out. And one thing that we have seen right now is that there's really a movement in Washington, D.C. For the rich to pay their fair share. But when we look at what constitutes rich in America, as we're looking at these specific benefits in retirement, the individuals that we're working with don't have to be making a significant amount of money to be able to live life and enjoy life before they find themselves being surcharged on benefits that they had not anticipated being surcharged on, which actually leaves them with less money at a point in life that they're not out working and able to go generate more money. So they can only spend what they've earned in retirement. This is a way to help them keep more. So, George, I want to say thank you for taking some time. And for those that may be interested in connecting with George and having an opportunity to visit some more with him and learn a little bit more about their software solution and what they're doing and find out some more about us, let me encourage you to reach out to us here at Vision Advisors if you're not already connected with us. Our number is 1-800-505-8489. That's 1-800-505-8489. When the voice prompt comes on and our voice tree answers, if you'll hit 0, that will immediately connect you to the next available business consultant in our office. You can also go to our website, visionadvisorsinc.com, and down at the bottom of the homepage, you'll see all of our business consultants listed there with their direct extension, as well as a link to their calendar, where you can actually find a convenient time that works for you, and you can actually schedule a 30-minute call with any of our business consultants to have an opportunity to talk about this unique solution and where it may fit. And if you're new, find some more out about Vision Advisors and how we can help you support your business. And from there, we'd love an opportunity to connect you with George and his team, help you to get appointed, get access to their program, and then get involved in this coaching and mentoring program that they're going to be offering uniquely to our advisors as an opportunity for you to be able to bring a very unique value add. And think about standing out in the crowd. Out of all the individuals in your marketplace that are having conversation with clients right now about retirement planning, I can almost guarantee that there are very few, if any, that are having the conversation you just heard George and I have on this call today with your clients. And if you want to find a way to stand out in the crowd, to be unique and different, and literally have a way to attract CPAs, attorneys, higher net worth clients, and business owner clients to you, this is a unique positioning tool that we can help you put together a marketing initiative around that can allow you to be seen as someone unique and different in the marketplace, offering something of unique value that allows people to keep more of their hard-earned money. So again, our number here is 1-800-505-8489, or you can go to visionadvisorsinc.com and schedule a convenient time to meet with us. George, any final comments as we wrap this up, sir?
Just to, again, reiterate the fact that the problem is not going to go away. And when there is a problem, there is a challenge, there is also a lot of opportunities. If you are not addressing these with their clients, don't wait until the last moment for them to be receiving the bad news from the Social Security Administration, because unfortunately, at that time, we are probably already too late. We need to be talking to the millennials. We need to be talking to, the Gen X's, the Gen Ys. Why? Because they are going to be the beneficiaries of all those qualified plans, the real estate, all that wealth that is going to change hands when the baby boom generation is no longer here. Exactly. The problem is that I know that. The bigger problem is that the government also knows that. So they're going to bank on the opportunity unless we do something about it.
And I love the fact that you guys have come up with a very innovative solution that opens the door to a number of planning options, as well as generational planning with the beneficiaries, which is something unique and very much needed in our industry. George, thank you for taking some time to be with us today. Ladies and gentlemen that joined us today, thank you for joining us for the call. We look forward to an opportunity to further the conversation with you. And if there's an interest, we welcome an opportunity to get you appointed with Vision, if not already done so, introduce you to George and his team, and get you plugged into the training, coaching, and mentoring that's going to be taking place so you can bring this very unique tool to the marketplace. So on behalf of all of us here at Vision Advisors, thanks for joining us and have a great day.